Hey everyone, welcome back to my YouTube channel. This is Senior Hannington, your accounting tutor. In today's video, we are going to see how we can prepare financial statements. I have a sample question here on your screen. The following is the trial balance of Aspro Limited at the end of their financial year on 31st May 2007. So we have this trial balance of Aspro Limited. As you can see, you have cash in hand, you have cash at bank, you have the land at cost, the trade receivables, you have provisions for bad debts, the trade payables, sales and purchases, you have the discounts. Remember, when it comes to the discounts, we have the discounts allowed as well as the discount received. Electricity, salaries, loans from directors, long-term bank loan, there is rent, bad debts written off, share capital, carriage inwards, carriage outwards. Then we also have the returns. But remember, when it comes to the returns, we have what we call the return inwards and the return outwards. We have the opening inventory, motor vehicles at cost, but these motor vehicles depreciate, and we have accumulated depreciation on the vehicles, that is 6,000. Then we have equipment at cost, accumulated depreciation on the equipment. So that is your trial balance. That is your trial balance, meaning that transactions were entered into the different ledgers. The ledger accounts were balanced, and then a trial balance was extracted, as you can see. So here we have the balance summary for each and every ledger account of Aspro Limited. We have some additional information. We have been told that you ascertain the following. Closing inventory at the year end was valued at shillings 20 millions. On one third of the rent paid is for the forthcoming year. The depreciation charge for the year on motor vehicles is shillings 2 millions, and that on equipment is shillings 4 millions, but both have not been included in the trial balance. Provision against the trade receivables of 20% should be made at the end of the year. Salaries accrued of shillings 6 million were not incorporated in the trial balance. So those are the end of year adjustments we have. Then we are required to prepare Aspro Limited's income statement for the year ended 31st May 2007. Then prepare Aspro Limited's balance sheet as at 31st May 2007. So those are the requirements of the question. You'll come up with the income statement and then the balance sheet. Remember, the income statement is prepared to determine the financial performance of the business. Is the business making profits or it is making losses? So we are going to see how we can come up with the income statement. Remember, you need to know the format. We start from the sales, we less the cost of sales, then we come up with our gross profit, then we less the operating expenses to arrive at the net profit or loss. So let us see how we can come up with the income statement, or sometimes referred to as the statement of profit or loss. So we have our heading. Don't forget always to come up with a heading: Aspro Limited statement of profit or loss for the year ended 31st May 2007. So I'll start with the sales revenue. So the sales revenue, we need to see how much is our revenue. Sales revenue, the sales. Now you have sales and purchases. They have started with sales first and then purchases. But for you, what you have to know is that the sales are always on the credit of your trial balance. The sales have a credit balance, so they will appear on the credit column of the trial balance. So the sales, we have 600,000. So we have sales of 600,000. But remember, on these sales, sometimes you may sell, but then you find that customers are returning back some of the goods. So we have returns. Where are the returns? We have returns here, and these returns on the sales, those are the return inwards. Their balance will always be on the debit column of the trial balance. So we list the returns. Returns, that is 30,000. Our returns, we have 30,000. The returns are deducted from the sales to arrive at what we call the net sales figure, which is the sales revenue less the return. So we have our net sales revenue. So our net sales revenue is 570,000 or 570 millions in this case. Now after the net sales revenue, or after our sales revenue, then we have to less what we call the cost of sales. We have to less the cost of sales. But how do we get cost of sales? To get cost of sales, you start with your opening inventory, and the opening inventory, you will find that in the trial balance. Find that in the trial balance. We have been told that the opening inventory was 3,000 as per your trial balance. It's 3,000. So opening inventory, we have 3,000. On that, you have to bring the purchases. The purchases, you will find them in the trial balance, where we have sales and purchases. The purchases, you will find them on the debit column of your trial balance, and that is 330,000. So purchases, 330,000. Now these purchases, I'll add the carriage inwards, costs incurred on transportation of these materials, carriage inwards, that is 12,000 as per our question. Carriage inwards, we have 12,000. So you add them to the purchases. But as you purchase, sometimes the business may also return some of the goods back to the suppliers. So we have the return outwards, that is the balance on the credit column of the trial balance, and that is 15,000 in this case. Those are the returns. When I get the returns, I deduct them from my figures up. We get what we call the net purchases. Put that down here. So that is your net purchases figure, 327,000. Now we add the 327,000, the net purchases figure, to our opening inventory to come up with what we call the cost of goods available for sale. So it's all about knowing the format of coming up with the income statement. So cost of goods available for sale, then we have to less our closing inventory. Closing inventory, you'll find that always in the additional information because it's an end of year adjustment. Closing inventory at the year end was valued at shillings 20 millions. So it's a minus. So we can come up with our cost of sales figure finally, where you get the cost of goods available for sale. then minus the closing inventory, you come up with 310,000. So 310,000, that is your cost of sales figure, which you will minus from your net sales revenue up there to come up with what we call the gross profit. So our gross profit is 260,000. That is your gross profit, 260,000. That is the profit on trading. You acquired or you purchased the goods, but then you have managed to sell the goods that you have purchased, and you're coming up with a profit of 260,000. So this is the gross profit, or what we call the profit on trading. That is what we have. After coming up with the gross profit, then you have to add the other incomes. There can be some other incomes that are earned other than the revenue, other than the sales revenue. So we have to show those other incomes, and under other incomes we talk about things like discount received. So you have to check in the question and see if there's a discount received. In the question you have discounts, but they are not clearly specifying whether this is a discount allowed or a discount received. But we see we have balances in the debit column as well as the credit column of our trial balance. What you need to know is that the discount allowed, that is an expense, it has a debit balance. Then the discount received, which is the income, that one has a credit balance. So the discount received is the 3,000 in this case. So discount received, it's a 3,000. Then the other incomes, normally whenever there is a decrease in provisions for doubtful debts, if there is a decrease in provision for doubtful debts, that decrease is added to the gross profit, so it appears as other income in the statement of profit and loss. So in the question we have provisions for doubtful debts of 6,000. That is our provision for doubtful debts. But in the additional information, we have been told that a provision against trade receivables of 20% should be made at the end of the year. 20%. How much are the trade receivables? The trade receivables, we have 15,000. 20% of 15,000, that is around 3 millions. But the provision in the trial balance, that is 60 millions, meaning that there was a decrease in provision for the doubtful debts. So that decrease in provision for doubtful debts, that is a decrease of 3,000. That should be added. So these are the other incomes. When you add them to the gross profit, 260,000 plus 3,000 plus 3,000, you come up with 266,000. We can call this the total incomes. Sometimes also referred to as the gross income. So that is your total incomes, or the gross income. That is what we have, 266,000. Now after that, what you'll do, you'll have to less the operating expenses. You'll have to less the operating expenses. Under the operating expenses, since we have discounts, the discount received, you have added that to the gross profit. But then there is also a discount allowed of 6,000, so you can start with the discount allowed. Discount allowed, that is an expense to the business, that is 6,000 discount allowed. Then there is electricity. Electricity is how much? Electricity is 21,000. As you can see, it's 21,000. Electricity 21,000. Then from the electricity we have the salaries, 24,000. Salaries 24,000, but there is an adjustment on the salaries. Let's check out the adjustment. Salaries accrued of shilling 6 million. We are not incorporating the trial balance. These are unpaid salaries which you have to add to the salaries that were paid during the year. So salaries accrued, you add them, that is 60 millions. So when you add the 6 millions to the 24,000 or to the 24 millions, you come up with how much? That is 30 millions. Those are the salaries. Then we have the rent. We have the rent. The rent has an adjustment, but 5,400 was paid. Rent from the trial balance we see 5,400,000. That is the rent that was paid. But 1/3 of the rent paid is for the forthcoming year, so there is a prepayment of 1/3. So prepaid rent. Since rent is prepaid, that portion that is prepaid belongs to the coming year, so we have to minus that, and the rent prepaid is 1,800. So meaning that to come up with our rent expense for the year, we get the rent that was paid, but we have to exclude the prepayment of 1,800, so giving us 3,600. Then what else do we have? I see we have bad debts of 3,600. Bad debts written off of 3,600. Bad debts written off 3,600. Then which other expenses do we have? Bad debts, carriage inwards. We have the carriage outwards of 60,000. Carriage outwards of 6,000. Carriage outwards 6,000. From the carriage outwards, of course, you have to talk about the depreciation that has been given, the additional information. The depreciation charge for the year on the motor vehicles is 2 millions, and that of the equipment is 4 millions. That is your depreciation. That is your depreciation. That is our depreciation. So you add the depreciation, you bring that depreciation in your income statement. So you have the depreciation expense. Motor vehicles. Then the equipment. that is a 4,000. Equipment, it's a 4,000. When you add these two, that is 6,000. So those are your expenses. What you have to do now is to add them. You add all the expenses. You add all these operating expenses. We get 76,200, and this should be deducted from our total incomes to give us a net profit of 189,800 or 189,800,000. This is your net profit. That is your net profit for the year. So that is the statement of profit or loss, or sometimes referred to as the income statement. It is prepared to determine the financial performance. How is the business performing? Is it making a profit or it's making a loss? So in this case, we see that the business is making a profit. Business is making a profit. So what you need to learn is the format of how to come up with this statement of profit or loss, or sometimes referred to as the income statement. So that is it. For the decrease in provision for doubtful debts, can just come up with a note here down. Note. This note is about provision for doubtful debts, just in case, because you need to find out if there is a decrease or an increase. If it's a decrease, it will be added to the other incomes. It will be added to the gross profit rather. Then if it's an increase, then it will appear as an operating expense. So for the provision, of course, we have an existing provision. Existing provision. The existing provision is given as how much? It's given as 60,000 or 6 million in the trial balance. But then there is a provision required at the year end. There is a provision required at the year end. The provision required at the year end is 20% should be made at the year end. A provision again is trade receivables of 20% should be made at the year end. So get 20% of your trade receivables. Trade receivables, we have 15,000 or 15 millions. So this equals to 20% times 15 millions. That gives you 3,000. So meaning that there is a decrease. The existing is 6,000, but what is required at the end of the year is 3,000. So you have a decrease in provision for the doubtful debts, and this is other incomes. You add it to the other incomes in the income statement. You add it to the other incomes in the income statement. By the way, in this question, depreciation has been given. It has already been computed for you, but in some other questions you will be required to compute that depreciation, so you always follow the additional information. Now from there, of course, the second part of the question requires you to come up with Aspro Limited's balance sheet as at 31st May 2007. So let us try to come up with the balance sheet. Let's try to come up with our balance. Let's try to come up with our balance sheet, sometimes referred to as the statement of financial position. So I have my heading here, so you have to write the heading, that is Aspro Limited statement of financial position as at 31st May 2007. We need a column for the cost, then accumulated depreciation as well as the carrying value. But these three columns mainly help us when it comes to the non-current assets. So in the statement of financial position, we start with the assets, and then under assets we shall start with the non-current assets. Those assets that are expected to be available for use for more than one accounting period, those are referred to as the non-current assets. And in this case, we have the land. Aspro has land. It has the motor vehicles. It also has the equipment. Those are the non-current assets this company has. But we need to see what is the cost of land. Land at cost 300,000. So land, its cost is 300,000. Then the motor vehicles at cost. Motor vehicles at cost, that is 30,000. Then the equipment at cost 60,000. The equipment at cost, just down there. Equipment at cost 60,000. Those are the non-current assets which we have in this case. When I add, we have 390,000 as our total cost of the non-current assets. But then we have to get the accumulated depreciation. Land does not depreciate, don't forget. Land does not depreciate. So I'll just put a 0. Then to get the carrying value, we get the cost of the asset minus its accumulated depreciation. Carrying value is the same as net book value, don't forget, though here I've decided to use the term carrying value. For the motor vehicles have a depreciation. When it comes to the accumulated depreciation of the motor vehicles, first get the accumulated depreciation from the trial balance. The balance broke down as at the start of the year. That is 6,000. That is your depreciation accumulated on the vehicles as at the start of the year. We have a 6,000, so we get the 6,000, then plus the charge in the income statement. The depreciation expense on the motor vehicles in the income statement is 2,000. So we get the balance brought down, then plus that's 2,000. The charge in the P&L, we get the depreciation of 8,000, meaning that the carrying amount of the motor vehicles or the carrying value is 22,000. Equipments, you still do the same to get the accumulated depreciation balance. Get the balance from the trial balance as at the start. Equipment, that is 12,000. Then you add the charge that was made in the income statement. Equipment, that is 4 millions. So plus 4 millions. Plus 4 millions, giving us 16,000. So 60,000 minus 16,000, that is 44,000, the carrying value. Get the totals. Our accumulated depreciation for all the assets, motor vehicles and equipment, that is 24,000. Then get your net book value, which is the cost minus the accumulated depreciation, giving us 366,000. I've told you that the carrying value is the same as the net book value. These are our totals. for the non-current assets, the total cost, total actual net depreciation, and then the total carrying value of the non-current assets. Now what we have to do, we have to move to the current assets. We have to move to the current assets. So current assets. We are on the current assets. We are on the current assets. Now you need to know, what are the current assets? What are the current assets? When you talk about current assets, we are looking at those other assets other than the non-current assets. We are looking at assets other than the non-current assets. Assets like inventory, the trade receivables, the prepayments, cash at hand, as well as cash at bank. So there are those assets of the company that are expected to be conveniently sold, consumed, or used within a period of 1 year. So let us look at the current assets. So we have the inventory, but remember the inventory that is the inventory in the additional information, and that is 20 million. So inventory, we have 20 millions, that is our inventory. Then from the inventory we bring in the trade receivables. The trade receivables. We bring in the trade receivables. So what are the trade receivables? Trade receivables, we have a balance of how much? Let me take you back to the question. The trade receivables, we have 15,000. We have 15,000. We have 15,000 for the trade receivables. So you show them, but remember, when it comes to the trade receivables, we have to net off the provision. We have to net off the provision for the trade receivables as at the end of the year. So trade receivables, we have 15,000. Then we less the provision. The doubtful debts. The provision for doubtful debts, that is 3,000. Don't forget the closing year provision, the provision that is required at the end of the year. This is the provision required at the year end. It is 3,000. So you have to minus that from the trade receivables balance as at the end of the year, and when you minus, you come up with a net receivable figure of 12,000. You will bring the prepayments. Remember, 1/3 of rent was prepaid, and that is 1,800. So the prepayments, you bring that 1,800. Then the cash in bank. Cash in bank, that is 12,000. Then you bring the cash in hand as well. Cash in hand is how much? Cash in hand is 6,000. Cash in hand is 6,000. So what you'll do, you'll have now to add all the current liabilities. We add all the current liabilities. That is a total of 51,800. We get our current liabilities plus the non-current to come up with what we call the total assets. Total assets. So that is the first part of the statement of financial position, where we talk about the assets, where we present the assets, and these assets are classified as current and non-current liabilities. From there, of course, we move to the equity and liabilities. Equity and liabilities. So I'll start with equity. I'll start with the equity section, and under the equity of ASPRO, of course, now here you talk about things like the share capital. In the question we have share capital of 78,000. Share capital of 78,000. Then after the share capital, we'll bring the net profit. The net profit from your part A, from the statement of profit and loss. Our net profit is 189,800. If it was a loss, then it comes as a deduction, but this is a profit. So when we add this profit, we add it to our share capital, we come up with how much? 267,800. That is total equity. That is total equity. Now from total equity, now within equity, sometimes you find other items like retained earnings. If you have retained earnings in the trial balance, then you will have to add them to the share capital. Then you also add on the net profit. But in this case, we don't have retained earnings. Retained earnings, those will be the accumulated profits from the previous years. But in this case, we don't have any retained earnings or the accumulated profits. From equity, I'll move to the non-current. I'll move to the non-current liabilities. Those liabilities that are expected to be repaid for more than a period of 1 year. So in the question we have long-term, the long-term bank loan. The long-term bank loan is 90,000. As you can see on your screen, it's 90,000. It's 90,000. It's 90,000. 90,000. So long-term bank loans, they have a 90,000. Then in the question we have loans from directors. We have loans from directors. When it comes to loans from directors, we are not sure whether these loans are to be paid back within a period of 1 year or for more than a period of 1 year. We don't have that information, which can guide us to classify them as either current or non-current liabilities. But what you have to know is that these are liabilities. So whether you take them as non-current and current liabilities, it may not make any difference because of the absence of more information about these loans from the directors. But I can decide to just assume that maybe they are long-term liabilities, so I can put them under the non-current liabilities. Can say loans directors, we don't know when they will be paid back. So loans from directors 45,000. Let me take them under the non-current liabilities, but someone else can still put them under the current liabilities on assumption that they are going to be paid within the next 12 months after the balance sheet date. So when I add these, when we add these, we get how much? When I add these two, we get our total non-current liabilities. Then I'll move to the current liabilities. Under the current liabilities, what do we have? Of course, we have the trade payables, that is 9,000. Trade payables, 9,000. Then there was accrued salaries. We have the accrued salaries, accrued expenses. Those are current liabilities, accrued expenses. Then the prepaid expenses, they are current assets, don't forget. Salaries accrued, that is 6,000 or 6 millions. Those are the only current liabilities we have. And when you add these two, we get 15,000. So what we have to do now is to add our total equity plus the total non-current liabilities plus the current liabilities. We get 17,800, and that is our total equity and liabilities. Total equity and liabilities. Remember, when you're preparing the statement of financial position, your total equity and liabilities should be exactly the same as your total assets up there. And we prepare this balance sheet on the basis of, we have to follow the accounting equation, which states that assets should always equal to the liabilities plus equity. So this is our statement of financial position for this Aspro Limited. In case you have questions, please feel free to add them in the comment section. I will answer them. We have seen how to come up with the statement of financial position, as well as how to come up with the income statement, as well as how to come up with the income, statement. Thank you very much for watching my videos. Thank you for learning with Senior Hannington. Don't forget to subscribe. Don't forget to share with friends, as long as you believe that this channel will benefit them. In case you have questions, please feel free. You can add them in the comments section. It's always a pleasure to serve you. It's always a pleasure that you, my fans, you're always watching my videos. It's very good. For those who are sending the feedback, thank you so much. I always receive that feedback. Thank you. Bye bye for now.